Good morning, and welcome to KBRA's Outlook for Private Credit and Borrower Performance webinar. While all attendees have joined in listen-only mode, we encourage you to engage with our speakers through the Q&A feature on your control panel. Ratings and additional research, including our recent Private Credit Outlook, can be found on our website at kbra.com. Our dedicated Private Credit microsite conveniently houses all of our insights in one location. This link will be shared with you during and after the webinar. Should you have any additional questions on the topics discussed today, we are always available for a follow-up call. Now, I'd like to hand things over to our esteemed speakers for introductions.
Thank you, Michelle. This is John Sage, Senior Director and Head of Private Credit Research. And today I am joined by three of my KBRA colleagues. Andrew, Global Head of Corporate Project and Infrastructure Finance. Eric, Global Head of Fund Ratings. And Shane, Head of Corporate Assessments. Today, we will be covering KBRA's view or outlook for the private credit industry in 2025. We'll be taking a deep dive into the credit performance of and also looking at the credit performance of nearly 2,000 corporate borrowers that we cover through our corporate assessment process. Our thoughts are from recent publications that can be found on our website and come from, and if we want to click down to one more slide. Here are our speakers, and click down one more. Our thoughts are formulated through coverage of all of the areas that you see here, from funds to BDCs, specialty finance to fund finance, and all of the underlying corporate borrowers that make up a lot of these funds. So with that, let's dig in. Starting with you, Andrew. With a new lineup of opportunities and challenges in the year ahead, how do you think it will affect the credit quality of middle market borrowers in 2025?
Thanks, Sean. I think with consumer health and employment remaining relatively strong, and prospects of lower taxes and reduced regulations, there are several tailwinds supporting stronger credit. But those same positives could also re-engenderize inflation, which would definitely have a risk to some borrowers. If we just step back and look at where we thought the Fed funds rate would go at the end of 2025, roughly 2 quarters ago, it was forecasted to be under 300 basis points. Now the market's implying 100 basis points higher. With the current forecast, only about 12% of the 1,300 middle market borrowers that we evaluate would see a lower all-in interest rate reduction. And then if we look at what that was in previous periods, when rates were expected to reach 300 basis points, around 21% of borrowers would have seen a material reduction. So overall, another year of higher rates could result in elevated defaults and limit growth prospects for some companies.
Absolutely makes sense. And if we want to jump 2 slides. One more, and next I'll jump to you, Shane. Based on the nearly 2,000 individual companies your team assessed through 2024, where do you think the overall credit quality of the portfolio that we observe stands?
Thank you, John. So from our vantage point, we actually continue to see revenue and EBITDA growth. They grew in 23 and 24, and they continue to remain robust. As we just published in our Q4 middle market borrower compendium, the revenue and EBITDA for the companies actually grew at a CAGR of about 17 and 33% respectively. Now, this growth has actually positively impacted the leverage and the coverage metrics of a lot of the companies in that same compendium. And as we show here, leverage is down almost a turn since last year, and interest coverage ratios for about 45% of the borrowers that we assessed in 2024 actually improved over that same period. On the other end, momentum behind the sales growth that we did see in 24 is actually starting to slow. And if some of those tailwinds that Andrew mentioned a little earlier don't actually materialize, sales and top line growth would obviously fall a lot more than we expect. So some reassuring signs though. We show here that EBITDA margin did grow in 24. So a lot of these companies have actually found tweaks to obviously continue to improve their overall profitability. So there's going to be some push-pulls that obviously occur, but we do believe that even in the face of potential volatility, some companies can obviously deliver some credit strengths.
That absolutely makes sense. But as a follow-up to that, Andrew mentioned they're forming a dispersion in the credit quality that we're seeing across our portfolio. What's your understanding of the top and the bottom of that distribution across the portfolio?
Thank you again. Yeah, so look, as we show here, there always will be a portion of the portfolio that is always going to be challenged. But when we took a look at our portfolio again that we sort of ran through in 2024, we only really saw about 5% of the portfolio that struggled enough to actually give us pause. So now all of these companies, those 5%, are going to be companies that were at the CCC levels, saw their performance as well as their liquidity kind of worsen through that 2024 period, and really gave us the belief that these are the companies that are going to be at a higher risk of default in this coming year. Now, most of these companies, they're in the construction, chemical, as well as consumer retail space. These are the space that you would expect are going to be heavily impacted by higher rates. So if you kind of think of industries that are going to be in housing, construction, consumer discretionaries, a lot of these companies are exposed to those industries. Now, to be clear, we're not saying that 5% of these portfolios are going to default because we expect private credit sponsors, private credit lenders to continue to pull strings to support their portfolio companies. But we are predicting that given what we are seeing in the portfolio, overall default rates may materially tick higher from what we saw in the past year. And as you also mentioned, at the other end of the spectrum, we do see companies that over the last few years have actually delivered not only revenue, but also EBITDA growth, and actually taking that opportunity to deliver their balance sheet. By count, that's about 27% of the credits that we looked through in 2024. So we believe these companies, obviously with additional capacity to capital raise, will be able to accelerate their growth strategy in the coming year. Now, this population obviously comprises of where you see private credit basically spreading their dollars. And so this is going to be companies in the consumer and professional services, software, and healthcare services and technology space. Now, we believe that these companies, obviously at the 27% top of the distribution, have the potential to outperform in 2025.
And one thing I want to double click on there, if you want to go to the next slide, is we also have a belief that that 27%, some of those companies will probably be great targets for additional M&A and the return of LBOs in the private credit and private equity space. As we can see here, there are a few M&A catalysts that are starting to crystallize or have been crystallizing over the past 12 to 18 months. The first of which we'd like to touch on is the mounting dry powder and the pressure that that puts on both private equity and private credit to find opportunities to deploy. Next is the fall in rates, but that's also happening at a time when multiples for really across the board, but as we look at here, S&P Midcap 400 index, the EV to EBITDA multiples are at they're at a 3-year high. And they've almost matched where they were prior to the rise in rates. So with a huge amount of dry powder, lower rates, great comparable multiples, we have the expectation that some of those or a large portion of the companies at 27% will be great targets for additional LBOs or M&A. But then the question becomes, what opportunities or will private credit be able to capitalize on all those financing opportunities? If you can go to the next slide. So a couple things that we're looking at here, and this is all relative to private credit and how it competes with how it competes for borrowers in the upper middle market with banks and the broadly syndicated market. So one thing we'd like to point out here is that the broadly syndicated market had a banner year last year and issued over 1 trillion and had issuance of over 1 trillion. That's also going to be supported by the huge amount of demand from the record amount of CLO issuance, the record amount of CLO resets and refis, which also add additional capacity for CLOs to go out and compete with private credit. And then finally, banks' abilities or banks' balance sheets nearing 5-year strength with their CET1 ratios. And the last piece that we'd like to point out here is the strength of the secondary market after or as rates are being cut. This is the first time we've ever seen, or at least in the past 4 easing cycles, where the secondary market for syndicated loans is strengthening, which likely will encourage borrowers to tap into or access the secondary or the syndicated market based on how strong it is relative to periods in the past where as rates were being cut, there was some sort of economic shock that likely closed down the syndicated market for some period of time. Where as of today, the syndicated market is wide open, and which gives a lot of confidence in execution and pricing. So now jumping back, Eric, with the relatively benign credit environment that Shane discussed and the opportunity for more M&A opportunities out there, how do you think this will affect the performance of the funds in your group?
Thank you, John. So I would say, what Andrew and Shane has mentioned is consistent with what we're seeing in performance of the funds. We've seen some slight credit softening in the quality of the portfolio companies that are backing the feeder fund rated notes into the direct lending funds, but nothing that falls outside of what we've expected given the recent economic environment. Higher interest rates, inflationary pressures over the past couple of years have naturally had an impact on the borrower credit quality. And with rates expected to stay higher for longer, we do anticipate that some challenges will persist. That said, the trends are well within our anticipated ranges. As previously mentioned, we haven't seen a meaningful increase in defaults. And then if you go to the next slide, please, John. We haven't seen a meaningful increase in defaults like I was mentioning. In fact, some of the companies have been able to increase their revenue. They've been able to cut costs, increase EBITDA, and as Shane mentioned, that's been able to improve interest coverage ratios. However, as you see in the green box there, we do expect default rates to increase slightly from, around 2% in 2024 to approximately 3% in 2025. And even with the modest increase, we expect the ratings on the feeder fund notes as well as the credit facilities to remain stable. With strong demand for the middle market loans as well as the solid credit performance, we have seen spreads tighten and valuations continue to hold steady. For those that aren't aware, most funds do rely on independent valuation firms to mark their positions, and that's typically done on a quarterly or semi-annual basis. And so far, the valuations have remained stable. Additionally, since most of the middle market loans are floating rates, they've adjusted alongside the rise in interest rates over the last couple of years, and that's helped maintain the stable valuations that we've been seeing over time. Looking at our rated portfolio of feeder fund notes into the private credit master funds, we do note that they include strong structural protections during the investment period. Those protections include cash sweep triggers that pay down the notes until certain LTV targets are met. And then after the investment period, most structures do shift to a sequential payment priority, which allows the notes to turbo until paid in full. These two features, along with, allow the structures to withstand these high levels of defaults that are multiples above our base case expectation. For example, as highlighted on that slide, you could see that non-investment grade facilities and investment grade facilities can withstand approximately 26% and 52% default rates, respectively. And as a result of the performance to date, and because of these protections, we haven't seen any downgrades due to credit quality. Shifting to your second question is related to capital deployment. We are seeing funds are calling their capital from the feeder notes, and they're deploying it into the portfolio companies as expected, both in terms of timing as well as purchasing portfolios or investments that are consistent with the credit quality that was outlined during the fundraising period. The last point is just that, despite the spreads tightening in the middle market space that I was mentioning, we do see that asset managers are still achieving returns that are in line with their expectation. And from our perspective, this demonstrates their ability to navigate the current environment while maintaining a disciplined investment strategy.
And that navigating the current environment, I'd like to double click on a little, where there's been subdued activity over the past few years in the corporate space and maybe some additional competition across the board. But have you seen fund managers reposition to continue to deploying and continue growing?
Yeah, I would say, the one thing that we want to monitor when you see a slowdown in this market is our fund managers remaining disciplined. And we are seeing that. They remain within the direct lending space. They've remained disciplined in terms of credit quality and tenor. They've remained disciplined in terms of lien type and, other credit attributes. However, what we have seen is that several managers are strategically positioning themselves in order to capitalize on what we view as the next major growth areas within private credit. And those are investment grade debt, which I'll let Andrew touch upon in a little bit. The second one being opportunistic credit strategies, and the third being specialty finance. And in our view, we feel these sectors are going to be the drivers for allowing private credit to reach its potential of $40 trillion market value. On the second point that I mentioned on the corporate side related to opportunistic credit strategies, we've seen that gain traction. And it's largely in response to what you highlighted, John, is increased private equity activity. A lot of these funds are managed by separate teams. They're funded through separate capital pools. And what they're designed to do is raise capital or make investments, not focused on distressed lending, but rather on companies that either didn't anticipate the rise in interest rates that we spoke about. They need to refinance debt, or they're financing a strategic acquisition and now require some sort of customized corporate financing solution. And what this often means is that managers, investors are structuring deals with a mix of senior and junior debt, a combination of preferred equity, or includes other features like PIK interest in order to create more flexible capital solutions. And then the last part, if you go to slide 12, the next one, you'll see the other area that I touched upon, and that's the growth in specialty finance issuance. In 2024, KBRA saw a 4 times increase in rated issuance in this area. This demand's being driven due to a variety of different collateral attributes, residential mortgages, credit card loans, consumer loans, but we're also seeing increased activity in infrastructure as well as other asset-backed strategies. And if we were to look ahead, we do see this as a growing area, estimated around 15 billion to 20 billion, and it does highlight some of the major areas where we expect private credit to grow.
It's incredibly helpful, Eric. Thank you. But you also mentioned too investment grade. And Andrew, it'd be great if you could touch on your view, especially in the project and infrastructure finance world, where you're seeing direct lenders set their sights.
Yeah, thanks, John. Maybe if we jump to the next slide, we could see some of the innovative structures that we've been seeing over the last year or two. If you're just looking at the overall kind of corporate investment grade market, the most dynamic area that we're starting to see is the use of project finance structures. And this happens when a company really needs growth financing, but also has an important asset that produces consistent cash flows. What we've seen are private credit lenders come in and support that initiative through a structure that we're showing here, which is basically a JV, where you'll have a company contribute an asset to the JV in return for equity proceeds. And then that company will agree to make a predetermined payment, either based upon a minimum volume commitment or an offtake arrangement. And proceeds from that agreement would then flow through the JV and be used to repay the debt that is usually issued by the minority interest and investor. We're also starting to see the growing opportunity and need for private credit financing in the energy transition and digital technology space. I think it was recently announced, and most people are aware of the U.S. government's $500 billion commitment for AI infrastructure. That likely won't be enough, and we'll see that in the development of data centers. And we're also expecting the private markets to supplement the public funding in many cases, just because there's not enough capital out there to really fund this energy transition. Overall, in terms of how we're looking at this year, we believe investment grade deals in the PFI space will continue to set records. We do expect structures to continue to innovate, and we expect the structures that we're showing here to continue to evolve. In many cases, these are attractive financing solutions for the company themselves because they're able to get equity-like treatment and still receive kind of debt-like treatment from a credit perspective. So this year, I think we'll continue to see the project finance space evolve and really become attractive for many investment-grade corporates.
And that absolutely makes sense. And the last area that we'd like to touch on in this presentation, if you want to go to the next slide, is where all the capital is going to come from. And the two main areas, and maybe a third that I'll throw in later, is insurance, where you see a lot of these partnerships that have formed really over the past 2 or 3 years. And they tend to be at the intersect of investment grade and specialty finance like investing. So insurance is a huge pool of capital, and we expect that to really fuel a lot of the new opportunities, or at least a lot of the growth in private credit going forward. Next is individuals, where the AUM in this space is 140 trillion and growing, where we've seen business development companies and various forms of business development companies grow 3.3 times over the past few years. There's been accelerating growth there. And now there's even new forms of funds or new quote unquote technologies forming for individuals to get into that space, that being interval funds, ETFs, and various hybrid funds. And then the last area is institutions in Asia. Some of the sovereign wealth fund, or some of the investments that Andrew mentioned, the sovereign wealth funds in the Middle East have very publicly said that they are attracted to those type of investments. But I'd be remiss if I didn't mention all of the financing that's growing alongside private credit, where we've seen some banks reorganize their leadership structures to really target, and we've seen other banks really lean into financing the private credit space. So with those kind of 4 legs to the stool, we think that 40 trillion number is likely attainable in 2025. We expect to see a ton of growth heading in that direction. So with that, we've completed the prepared presentations. Now I'll transition to some of the audience Q&A that I'm seeing here. And maybe Shane or Andrew, with in the compendium, there was some talk of the additional leverage capacity created by some borrowers last year that creates opportunities for them this year, either from an M&A or growth perspective. Can you expand on that a little bit more?
Yeah, I can take that. Thanks, John. Look, I think what we are trying to get there is that as you sort of saw revenue and EBITDA growth, a lot of companies were obviously able to use that to delever their balance sheet. And that creates obviously a lot of opportunities when you get to dislocations that could occur in 2025. We're looking at relative performance here. So these companies obviously have additional room. So if their call it leverage has gone down to the 4 or 5 times range, the capacity to borrow to continue to obviously manage their interest coverage and their profitability in such a manner to outperform their peers. So whether that's strategic acquisitions, whether that's even opening additional CapEx facilities to be able to incrementally grow those obviously will be in there. So I think that's what we talk about when we say those additional space will be what makes a difference in 2025. Those companies that have gone out of their way to position their balance sheets to allow them to outperform their peers in 2025.
Very helpful. And another one I'm seeing here, maybe Eric, I'll throw this one to you. How would you expect managers to capitalize on the specialty finance opportunity, considering most of them aren't necessarily set up to originate and manage an entire portfolio of student loans or resi mortgages?
Yeah, I think that's a great question. And if you go back to your earlier slide, I thought that was great. Just looking at the assets under management and then the relationship that they have, back to, nope, down one. And going the wrong direction. I'll just skip over that. But one more. There you go. So you look at the insurance assets under management, and a lot of that capital has to be deployed into these different strategies. So as you can imagine, scaling originations in order to match the assets under management is a big challenge, especially as you move into the asset-based financing, where there's often quick turnover on these shorter duration, right? So you have to reinvest into new portfolios and new loans. So I think that is a challenge for a lot of these private credit managers that don't have dedicated origination platforms themselves. What we've seen in 2024 and earlier, and we expect this trend to continue, is that private credit is increasingly turning to banks, fintech companies, and other origination platforms in order to acquire these loan portfolios, either in bulk or purchasing them on a forward flow basis. And I think one of the primary objectives around that is constructing a portfolio where they can grow originations and it matches the risk return profile in terms of credit quality and returns for the funds themselves. And this has really created a collaboration across the space between some of these consumer loan, credit card, residential solar, residential mortgage originators, and some of these platforms. So I think really what we're seeing is you see partnerships between credit managers, portfolio managers, and insurance companies. You can add another column into there where you're creating an origination flow arrangement with a lot of well-established loan originators.
Yeah, that absolutely makes sense. And I'm not seeing any additional questions coming in. If there's any additional questions, I'd say this is the last call.
Hey, John, if I can chime in, look, I think one of the things I do want to get across, as we've mentioned, what we forecast is a slight increase in default rates. I think one of the questions that a lot of people will have is, well, what does that mean for sort of the liability management exercises that could happen in 2025? I think one thing we expect is that a lot of that stuff will continue to go on, and that's not necessarily a negative occurrence. The very fact is that a lot of sponsors and a lot of lenders continue to believe in their credit thesis that went into the initial investment. And so obviously through any market dislocations, as long as that thesis continue to play out, they will do whatever they need to continue to obviously maintain their investment. So LMEs, we expect to obviously increase in 2025, and we anticipate that some might actually forestall defaults. And that's going to be credit positive, because obviously if you can provide the additional liquidity that a company needs to get through a period of dislocation, such that in later periods, a company obviously right-sizes its balance sheet, that is exactly what we think private credit is and can do better than many of the other asset classes out there. But at the end of the day, LMEs are going to increase. Defaults will will tick up. But at the end of the day, we are forecasting about 3% defaults in 2025. So still relatively restrained.
Yeah, absolutely makes sense. Yeah, and with the ability of private credit to manage through a lot of that risk that we've seen, or a lot of the headwinds that we've seen thus far, hopefully it assumes that it will keep LMEs relatively contained. But one additional question from the audience here: are there concerns about lending with tariffs, higher inflation, or higher interest rates later on?
Yeah, I think, John, obviously, tariffs could result in with higher inflation. I think that's been the question that we all have right now. Is we were going into this year, I think most thought we were going to see an acceleration in the decline of interest rates, and we looked at that. What would this decline mean on our portfolio in terms of their ability to service a lower amount of debt, and what that would do to present potential exits and acquisitions, whether it's tuck-in acquisitions, and that could potentially drive revenue higher. Now, if we see higher interest rates and we see higher interest rates, higher inflation, that's obviously going to have an impact on the performance of the portfolio. And I think in that scenario, you could see an increase in defaults. Right? I think as Shane mentioned, right now we're forecasting somewhere around 3%. It wouldn't be surprising for that to be higher than that if rates decline slower than we thought. So I think that's the one question in terms of what happens. Will tariffs actually materialize? Like, you hear one day that they're going to happen and then they're suddenly paused. So I think there's a great deal of uncertainty with those right now, and really trying to understand what that does to rates and overall what that does on credit performance. So it's a great question, one we think about a lot. But I think one could make the argument that if we do see higher tariffs and we see higher inflation and higher rates, that's going to have a negative impact on the credit performance in our portfolio.
And that absolutely makes sense. And I think that's all for the questions that I see submitted from the audience. So with that, I wanted to thank my fellow panelists and all of you that attended today's conversation. Again, feel free to reach out to any of the panelists that you've seen today or some of our business development folks to continue the discussion. Thank you so much for attending, and I hope you enjoy the rest of your day.